who said they want to own a business in here? Raise your hands. What kind of business you want to own? And by the way, give me your name so I can get used to you, because I don't have a lot of interaction. So the more I get your name, I can know you better. What's your name, sir?
Reed.
Reed. What kind of business you want to own?
Nutrition consultant and personal training.
Nutrition consultant, personal trainer. Someone on the next row who had one. Or next row? Yes.
Real estate investment company.
Real estate investment company. You two are my favorite people. I'm going to talk to y'all and learn a lot from you, okay? Either way, we're going to take these two businesses, okay? All right. What do you need to get started in that business? In either of those? Money. Cool. Anything else? Space. Experience. You do have to have some experience. What else? Some what? Say assets? Cool. Assets. That's where I'm actually going, okay? Now, I was getting a list of assets, okay? You said money. That's the top asset you can have. We refer to that as, of course, as cash in here, okay? Not just cash, but things like, money markets, treasury bills, things that can readily turn to cash really easy, okay? That is an example of an asset. With your nutrition, you're going to need to store things, okay? With your house, you're going to have a list of inventory, right? Those are different types of assets that we have, okay? So assets, think about that, all right? When you get that first batch of nutrition or when you get your real estate inventory, how are you going to pay for it? Doesn't matter to me, but I need to know how you're going to pay for it. Loan, okay? That's fine, okay? There are two ways to pay for it. You can pay with it out of your pocket. I can give you $20. Well, I can only give you $5, okay? I can give you $5 towards that. The rest of it you have to get for a loan, okay? Same for you. If you pay for it out of your pocket, that's equity. That's the equity you have in your business. If you get a whole loan, I'm going to kind of move out a little bit, say you need a car, a vehicle or something. If all you have is a vehicle and all you have is a loan, you don't own part of that. You don't own it, correct? But if you pay cash for that entire vehicle, you actually own it. Make sense? So think about it. You have assets, and you're going to pay for them one or two ways, either by borrowing or by using equity. If you borrow, we refer to that in here as a liability. Okay? So your assets are either owned by liabilities or how you buy them, and equity is what you use to buy for it out of your pocket. Now, you get some of your liabilities from things like banks. You can get stuff from your friends, and if you have to pay them back, that's still a liability that you have, okay? Whether it's short-term or long-term is a different subject, but short-term basically says you pay them back within a year. Long-term is usually more than a year. That's not a big thing for right now, but what I'm trying to do is show you that you pretty much know accounting. We just have to talk in the language that you need to have it in. Make sense? Okay? Now, when you get your business, you started, you have your assets, and now you start to generate cash, money, and buy things, okay? The money that you make, we're going to refer to that in here as revenues. Got it? Now, there's some more to that definition, but just in general, the money you make is referred to as revenues, okay? The things that you purchase. When you purchase them, we're going to call those expenses. Okay? And when you take your revenues and subtract your expenses, you have some what left over? I like that. That's where we're going, but let's say profit or income, okay? That's important. You have your profit or your income. Revenues minus your expenses is your income. If you put just that on a piece of paper, then what you have is an income statement. You ever heard that before? That's all an income statement is, revenues minus expenses. It tells you what you have. Now, there are some things we're going to talk about to expand. For instance, you may pay part of your bills now, part of them later. If you pay part of them now out of cash, that's fine. If you pay for them next month, that's fine as well. But you have to do, and don't worry about these words now, you have to do what you call accrue it now, which is basically set it aside for this month, and then pay it later. That's why I can't say cash. You see what I'm saying? It's still January. So if you're going to pay something next month for this month, you need to know all the expenses that are related to this month, right? Let's say you only generated $100 of revenue, but your bill is $150. Well, if you wait to pay all your bills over there at $150, it's going to look like you had $100 this year, right? Or this month. That's incorrect. That's why we are going to start to accrue in chapter 5. Okay? So your revenues minus expenses is going to give you an income. It's going to give you income, and that's going to be recorded on what type of statement? Income statement. Okay? Take a second to see if you have any thoughts. Now, after you record that income, you have your income left over. You can pretty much do one or two things. You can kind of pay stockholders with it, or you can retain it in your business. What does it mean to retain it in your business? Keep it in your business. Do things that you're going to do that are going to come up with, right? So watch this, your income statement. All the income that you do not distribute in terms of for your expenses, all of it is going to flow into a statement of retained earnings. Okay? That's the second financial statement you'll have. We have 4 financial statements. The first one is an income statement. The second is a statement of retained earnings. And the statement of retained earnings includes all of your what that you did not distribute. The statement of retained earnings includes all of your what that you did not distribute? Income. There you go. Okay? You're going to see how these things flow. Income statement, I don't spend it all. It's all going to flow into the retained earnings. Okay. Now, everything that I don't spend out for my retained earnings is going to become some more equity to me. Now, the equity is going to fall. We just talked about that in terms of your assets, liabilities, and equity, correct? If you see something like assets, liabilities, and equity, chances are you're looking at the third financial statement, which is a balance sheet. Okay. So what is a balance sheet? Assets equal liabilities plus equity. That's where we first started. And that's where it all ends up. If your balance sheet is correct, you've done everything else correctly. Okay, now you're not going to have to do that anytime soon, like next week or tomorrow. But what I'm basically doing now is giving you the first 4 or 5 chapters. You ever take a skeleton and you just kind of put different things on and take a Christmas tree better and you decorate the Christmas tree? All we're going to do after that is decorate, cosmetics, put something on the house, sell some new nutrition things, okay? That's all we're going to do after that. So any questions so far? Your 3 financial statements, we're going to have 4, but the 3 that you have so far are your what? In the correct order all the time. What's the first one? Income statement, statement of retained earnings, and your balance sheet. The 4th one we will not discuss in here, but you need to know it. It's a statement of cash flows, okay? And that's what you're going to get in managerial accounting whenever you take it, okay? It's in this book, but it's not something we try to emphasize in this class because it'll be a little bit too much. All right. So now your 4th financial statement, starting with the first one is income statement, statement of retained earnings, balance sheet, and statement of cash flows. Okay. So now let's think about this a little bit. We know assets. We can just list them. Okay. We can go down the line. We'll list some in a second. And we know our liabilities. Basically, that's a general term, who we owe. It can get a little bit more specific, but in general, that's who we owe. And the equity is what we have. But let's take those assets, okay? If you write down an asset, you write down cash, inventory, and vehicle, okay? If I just write that up there, what does that mean to you? It means I have an asset. It just means it's an asset. But does it mean my assets increased, or does it mean it decreased? Which one does it mean? You don't know just looking at it, do you? It's just a word. So what we do is we have to develop a system, okay? And that system is called debits and credits. Now, look at me. The word debit is right, means right. The word credit means left. And by themselves, those words don't mean increase or decrease. You got it? So debit means what? And credit means left. And those words don't mean anything, okay? And actually, let me turn around. If I'm writing, let's say, if I'm writing on the board here, you'll see debit means left and credit means right. So just think, I'm sorry about that. If I turn this way as we write, we'll see. Your debits are going to be on your left-hand side. Credits are going to be on your right-hand side. It doesn't mean a thing until you put it with something. For instance, any music majors in here? Anyone play any kind of music or whatever? Sing? Anybody? Okay, all right. You saxophone, okay? Middle C. Is that a good note or a bad note? How you know? What if it's in a A scale and you want a major scale in A? Is it a good note in that scale? That's okay. Here's the point. It doesn't matter until you know what it's associated with, right? You know, if you, hey, this class pretty good. No one has on other schools' paraphernalia. That's good. I come up here and you got people wearing Mississippi State, Ole Miss. You gotta have pride in your school. If everybody's like, yeah, we had a winning season last year, man. That's all right, okay? So the thing is, it's okay to wear a Southern Miss shirt, okay? But if you wear a Southern Miss and you go to a Ole Miss game, that's not what they do there, right? So the same thing with the debits and credits. Now, that asset that we talked about, you're gonna have to debit it, you're gonna have to credit it sooner or later. But how do we show an increase in assets? We show an increase in assets by debiting them. Okay? And we show a decrease in assets by crediting them. I'll show you what that looks like in a second. Okay? We show an increase in assets by debiting them, and we show a decrease in assets by crediting them. Okay? And just kind of keep that in mind. I'm going over some things this is just laying the groundwork for you, actually for your first exam. Now, we said assets equal liabilities plus equity, correct? Okay. So, if I do something on one side, which is assets, then everything else on the other side has to find some kind of way to balance something, right? Let's just take me. Just say I'm just an asset, okay? If I have assets on this side here and they go up, then somehow I have to make it go up over here. So, everything on the other side of the equal sign, in order to increase it, you'll increase it through a credit. Okay, if you increase your debits over here, then you're going to increase your credits over here. Okay, so assets are increased by what? A debit. Okay, your liabilities and equities are increased with the what? Credit. Okay, so only when you associate it with something is will you have a whether it's good or bad in terms of what you want to do. Now there are going to be exceptions, but that's a general rule. If everything you did fall under there, you would still pass. You'd probably make at least an 80. So just know the rules. Every class you go to, know the rules, know the concepts, and exceptions, they'll just take care of themselves. Okay? All right. Any questions? Yes, ma'am.
You said liability and equity increased by credit.
Right.
And what was the one with assets?
That's the debit because it's on the other side of the equal sign. Okay. So just think about if you get the assets right, then everything else is going to it's on the other side of the equal sign. So if you just remember, increase your assets through a debit, and everything else over here, you increase through a credit, without the exceptions that are going to come up. Okay. Yes, ma'am.
So it wouldn't be decreased by credit on the liability and equity side. It would be credit. I mean, it'll be increased on both sides, but one side will be the debit, one side will be credit.
I think I got you. Let me restate what you're saying. Let's start with the assets. We start with the assets because it's really easy, okay? With the assets, you increase that through a debit. So you decrease it with a what?
Credit.
Or the credit. Now you want to take that and do the opposite on the other side of the equal sign. So if you increase your liabilities and equity with the credit, then you decrease it with a debit. And that's the general rule. That's a general rule. Now, like I said, you have exceptions or things that count a little bit different, but in general, that's what you have.